Dani, how's it going? Thanks for joining us in the podcast.
Thanks, David, and great to be on. Really excited about talking about public markets and TSX for the next 5 hours or so, right? It's a
Yes, sir.
documentary feature that we're doing here today, right?
Yes, sir. And, people tend to like, watching things in like hourly increments at the very least. So it's a new thing in 2025. Like the old, 1 minute attention span is gone. It's like an hour at a time is the only way to get it across. So perfect.
Yeah. Who cares about that too long didn't read it thing anymore? We're changing up things in 2025. Yeah.
Exactly. Real innovators, which, the word innovation is one of the first thing that comes to mind when I think about you, kind of synonymous with the TMX, TSX, TSXV, in my experience with it, which, goes back to, listing a company and getting to know you through that experience. But I think it's a lot for a lot of folks. It's like this unknown, and especially those who have not gone public or been public. It's always in the news. It's something that's high profile, but I don't think really people understand behind the curtain what happened. So I'd love to learn more and educate our audience and share some insights. But maybe just first off, your role at TMX. Tell our folks, what you do there.
Yeah, no, thanks. I've been at the TSX now for about 13 years or so. I've had a variety of different roles. I started off actually on our listing side, which is made up of a lot of accountants and lawyers who actually do the review of our newly listed company and ongoing transactions. I then spent a couple of years heading up our exchange traded fund or ETF business. This was back when ETFs were about 40 billion in assets, just a handful of providers. Now today in Canada, there's about 500 billion of ETF assets. We got about 45 issuers, so it's grown quite considerably. Now, about 5 or 6 years ago, I transitioned to this role. So what my role is today is heading up our innovation sector. And so what does that mean? Most people actually come to me on LinkedIn spamming me thinking that I control all of our technology within TMX. That is not what I do, though we are a technology business at our heart. My role is really working with tech, clean tech, life sciences company, both in Canada and around the world, and helping them navigate the process of going public in Canada, and then also working to advocate on behalf of the entire innovation economy in Canada. We are kind of full believers in the fact that we need a vibrant innovation ecosystem, and both the private and public markets, in our opinion, kind of play a vital role in making that a bigger part of the economy overall. What I do today is kind of work with a lot of founders, CEOs, investors, and help them understand when's the right time to go public, how you go about going public, who to speak to overall, because it's a long journey to get public. It doesn't just happen overnight. That's kind of essentially what my role is. But if you ask my children what I do, they would think I just get up in the morning, go and clap at 9:30 in the morning as we welcome the TSX.
Ring a bell.
That's not my job.
That's awesome. So would innovation then, obviously there's innovation on both the TSX and the TSXV. Are you equally focused on both exchanges? Maybe break that down for folks, describe what the difference is and where you focus.
Yeah. So for people who aren't as familiar, we actually have two different exchanges that we run. So the Toronto Stock Exchange, TSX, which is well known as some of the large multinational, multi-billion-dollar companies, some of the largest companies in Canada there, the S&P TSX Composite, which you hear every day, that's the TSX. The TSX Venture is more geared towards the majority of companies in Canada, which are small to medium-sized enterprises. And so if you actually look at the average market cap on TSX Venture, it's about $40 to $50 million in market cap overall. And this is actually where the majority of companies in Canada actually get their start as a public company. And that's usually because, they're not at that multi-billion-dollar stage, but they need a bit of growth capital to accelerate business plans. And then the goal is with all of our TSX venture companies is to eventually graduate them up to TSX. And so I mentioned before that S&P TSX composite, which is about the largest 225 companies in Canada, 20% of those companies actually started life on TSX Venture. And just one more clarification between the two exchanges, TSX, it's set up for those multi-billion-dollar companies. The securities laws kind of reflects, the stage of those size of companies. TSX Venture Exchange is actually, considered a junior venture exchange according to the securities law in Canada. And so as such, from a regulatory perspective, it's a bit of a lighter touch for those companies because obviously those types of companies don't necessarily have the same bandwidth and capital to spend on being a public company as the Royal Banks of Canada, as Shopify's, as Kinaxis, right? The regulatory regime is set up that it's a bit of a lighter touch, gives them more flexibility, and that's why it is so successful overall, because it gives smaller companies access to public capital, but not necessarily having to expend the same amount of time, energy, and costs as the likes of Shopify and Royal Bank.
Do you think that awareness, like that, there's a lot of time you spend on education, and a lot of these businesses don't really know about? I mean, I think most of the headlines are geared to the TSX, the big board, the billion-dollar, multi-billion-dollar companies. Is that a large focus for you in terms of letting companies know that this exists as an avenue to access capital earlier on in their life cycle?
Yeah, absolutely. I mean, the number one thing when we're talking to entrepreneurs, the number one issue faced by them is just access to capital. And so what we try and do, because, Canada is a country made up of small to medium-sized enterprises. And so we want those companies to understand what are their capital options overall. The IPO, that is very well known. We're not necessarily needing to tell people there's the option to go public with a large IPO and you get your confetti raining down on you. That's also an offer available to our TSX venture companies. But what I mean by this is that it's when you get to a certain size and scale, there's a lot of people also talking to these companies about doing an IPO when you get to those certain size and scale. But for all those smaller size companies, they need to understand what their financing options are overall and where can they access this capital. And the vast majority of Canadians, still don't know about the TSX venture option. And it's something that we're continuing to educate people because the majority of companies, as I said, that actually go public in Canada, it is on the TSX venture on a yearly basis. And so what we're educating people around is what is the right type of company to go public on TSX venture, because it is not for everybody. People will come to us and say, I have a great business. It's been around for 150 years, hasn't grown a single day since 10 years ago, and I want to go public. And then we kind of say, that's great, amazing business you've created, but public market investors aren't necessarily going to want to be investing in that type of company. And so we kind of show them the profile of what are the successful case studies on TSX Venture, what are the kind of metrics that have been positively received, what sectors are in favor. So people are aware TSX Venture has been around for, about 20, 30 years now through different iterations. It actually came together through all of our different regional exchanges that existed in Canada. We used to have the Vancouver Stock Exchange, the Alberta Stock Exchange, the Montreal Stock Exchange. It's kind of all came together over the last 20, 30 years. And what it has been typically known for is mining. And this isn't going to be a 45-minute podcast about mining, but we're going to have to say one very nice stat about mining because, we are very proud of our mining franchise overall. 50 cents out of every dollar in the world in mining is basically raised on TSX or TSX Venture. But that's getting back to the point, TSX Venture was started up for a lot of these junior exploration mining companies. And what we've tried to do over the last 10 to 15 years is utilize this junior venture exchange for innovation companies, for diversified companies, for CPG companies, for fintech companies. And that's what's been now a growing source of the new companies listing overall. Prior to about a year ago, over a 5-year basis, the number one sector for new companies listing on our exchanges was innovation, and it primarily was on the TSX Venture Exchange. So more and more companies are realizing, hey, this could be a good path for me going forward to raise that $5 to $10 million as an alternative potentially to a Series A venture capital round.
So that's a great kind of segue to what I was looking to get at next, which is, what does that decision path really look like? So you're not just an owner managed business that grows, 2% a year. You can be highly successful, but it's got to have a sort of growth story and trajectory that can really get the excitement of a market and grow over time. There's access to capital. But as you just noted, the venture is a typical route that people would think about for innovative companies that are on a high growth trajectory, early stage. So what are the sort of pros, cons, or decision points there when I can go venture versus public?
Yeah, that's a very good question. And it's probably the number one thing that comes up with us. Similar to when you're talking to venture capital or private equity, the first thing that investors in the public market would look at overall is your general metrics. So as you alluded to, a 2% growth for the last 12 years, owner operated business, that's great for that owner operator, but it's not necessarily an interesting story for the public market. So the first thing people are going to ask about is, what's your growth rate been like? What's the margin profile of the business? What is the total addressable market that you're going after? Who is the management team behind it? What's their experience overall? Have they been involved in the public markets? That's a little bit more of an element that will come up in the public markets versus the private markets. And it's really understanding, what's the business? And then how much money does the company need to raise? And what is it going to be used for ultimately? Is there actually a good use of proceeds for why you're coming to tap the market? Is it just pure liquidity for the company? That's never necessarily good reason to go public in and of itself. Yes, liquidity is a great long-term option in the public markets, but if a company comes to us and say, oh, I want to go public because we want liquidity, that's not a great answer. The reason to go public is to access the widest pool of capital available and to grow and accelerate the company. Because if the first answer you say is liquidity, investors will come to you and say, well, if it's such a great business, why are you getting out and I'm taking on all of the risk of the go forward business? I'm buying the future cash flows of the business. So if this is such a great business, why are you exiting at this point if there's a lot more to come? The other thing that kind of, we talk about a lot too, and you mentioned, is just flattening out the cap table. When you go public, and this is what a lot of people talk about, is generally speaking, for most companies, you're only going to have common shares outstanding, meaning everybody's on equal footing, equal ground. And a lot of serial entrepreneurs in Canada actually like this idea that you're going to go public and nobody necessarily has any greater right in terms of voting right or say on the direction of the company. It's based upon what your equity ownership is, and everybody's on the same ground and same footing. That can be a little bit tougher sometimes in the private markets just because of the terms that private investors may come to terms of the table with, in terms of those terms that they're offering.
Liquidation preferences and these waterfalls where they get paid handsomely before anybody else would get paid on an exit. So yeah,
exactly. Yeah. Right. There's different ratchet provisions and different liquidity preferences overall. But when you go public, everybody has daily liquidity. at the end of the day, subject to some stipulations, but, there is the ability that, hey, if I don't like the direction this company is going through, I don't need to force some type of event on the company for me as a shareholder to get out. And that's what can come up a lot of times in the private markets. And that can be a big source of tension for private companies, right? When things are going great, everybody's happy. But when things aren't going great, that's when, tension comes up. And in the public markets, if you just own 2% of the shares outstanding of a company, you can just get out. If you own 2% in a private company, it's tough to figure a way to get out very neatly at times. And so that's why we, champion this ability of liquidity in the public markets that's quite different from the private markets overall. So this is going back to what are people looking at? It's, the growth, the profile of the company, it's the use of proceeds overall, and it's what's the long-term story of this company. The public markets, not always for companies, but what we say is you should think of it a lot of times as how can you build a generational company? Because that's what the public markets allows you to do. There's very few generational companies on the private side that aren't just family controlled businesses, because it's really hard to do. At some point, your investors are going to need a return of capital. In the public markets, it is permanent capital that you're receiving from investors. Yes, you do have to eventually give them some type of return through maybe a dividend or, share buybacks, but there's not a set period to which you have to give them their money back. In the private world, funds that come in, you might have a 3 to 10 year horizon by which those investors need their money back. And so that's the difference a lot of times that we say public versus private, permanent capital versus not permanent capital.
And so when faced with that decision and you check all the boxes for public, you might at the same time, many of those boxes would be checked for going down the venture route. Does that just come back to what you're speaking to in terms of what are your long-term ambitions? Because in the private route, the venture route, you're ultimately going to go public. Yeah. What does that discussion look like when they check all the boxes? They've got the hot story. VCs might be equally as excited as the public markets. At that margin, what does the discussion look like?
So it's a handful of items that would come up. So one is predictability of the business. In the public markets, the unsexy part is needing to release quarterly financials. You have daily trading liquidity on it. There needs to be some sense of understanding where the business is at and where it is going. For a lot of businesses, great private businesses, they're still in the unpredictability mode that they don't actually even know what the next quarter is going to bring in terms of their sales pipeline conversion overall. That can be sometimes hard to manage with public market investors because, they want a little bit of predictability. It doesn't all have to be, okay, we're going to grow 40%, 50%, 60%, but at least they have sight line into how you're going to be doing over the next few quarters. And you as a company need to be able to deliver on those promises. So if you're still at a point where we don't have great forecasting abilities, we say maybe it's not yet the right time to go public because it's going to be hard to align yourself with investor expectations overall. Secondly, I guess it's the time commitment a little bit too. There is an element that needs the CFO and the CEO time to commit to things you're not doing as a private company, such as interim financial statements, audited financial statements, spending time on the road, meeting with investors. And if you don't necessarily have that time available because you're still in that high growth, high building phase, it might not be the right time to go public yet. And it's also inflection points. If you think that you're growing 20, 30% now, but you actually could, grow even faster after another round of private capital, well, then maybe wait for that next round of private capital to inject an even higher growth rate, because the ultimate question that comes up also most of the time is, what's the valuation overall? Is my valuation going to be better on the public or private markets? Most of the time, you will see that it will be better on the public markets because there is a liquidity premium overall. But what is that gap? Is it significant enough to justify those extra work items that I kind of have alluded to about, financial statements, meeting with investors, road shows overall, that come in the public markets and not the private markets? And so those are the pros, cons that you have to evaluate. And it's something that you constantly have to evaluate. Are the public markets open right now for that type of company and being able to fund you on the public markets? There were periods 2 years ago where, public markets were, quite quiet just because of the volatility, the interest rate environment, and just the instability overall macroeconomic. But that has started to come back, and we're seeing again a market where there is more appetite for financing activity.
And so I guess you're also looking at the venture market at that time, which, ebbs and flows in terms of, how onerous are terms. Are they, business friendly, or are they investor friendly? I really, appreciate you bringing up that, the valuation part. And then it's not a question of just what valuation, but on a sustained basis. And then will the market get it? And if your story requires explaining why revenue is going to be down next quarter and down next year, but just wait, it gets trickier than if you're a, clear growth story with predictability that's going to keep the market excited. And then the specialization part that, venture could sometimes bring you. If no one else gets your story, sometimes you say you might be better with really smart money on the VC side that will help unlock your business. So I think that's, a great point as far as the decision point. And then you were taking it somewhere else now, which is the timing and the market. So maybe a good chance to hear from you on where the market is today. I keep hearing everyone say it's going to open up and you're going to, hear about all these IPOs that are waiting to happen. Where are we at?
It's been a bit quieter the last year or two, just in terms of market activity. And a lot of that has just been related to the high interest rate environment, a little bit of a more precarious macroeconomic environment. I mean, this week that we're recording, it's been relatively quiet. There's only been like a prime minister resigning, the U.S. buying Canada. I don't know what will happen today. Who knows? But, for the public markets, just stability is always a good item to have. And it doesn't necessarily matter who might be in power or whatever is going on overall, but just understanding what we are in line for. That is very helpful for the markets, and understanding where our interest rates are going. And we did see a downturn, both private, public markets, just in terms of financing activity over the last 2 years. But we've started to see a nice pickup, I'd say the last quarter or two, in terms of financing activity. And where it has to start for us in the public markets is actually financing activity for our existing issuers. Those are the companies that investors already kind of know quite well. They've seen them for a number of years. They've seen how they've been doing. Investors are more willing to invest in a company they already know quite well than the newer companies, just full stop. And so we've seen a number of bought deals in Q4. Some of those deals are actually even closing this week. And we even saw a very nice IPO at the end of 2024 with Group Dynamite. It's a fashion retailer. They raised $300 million, all secondary offering. So actually all of that money went directly to the founder shareholder. So it was a very nice, well-received IPO. We have also seen pickup in activity in the US market, and sometimes that can be a bit of a bellwether for how we're going to see activity in Canada. And we've also been seeing now our venture market having better financing activity on the new listing side. So from our perspective, I think we're optimistic. The discussions that we're having with companies now is a lot more fulsome than it was 12 months ago. We're seeing people starting to be engaged, starting to prepare prospectuses, really starting to advance it because the window is starting to open. A year ago, you could sit in cash, get 5 to 6%, invest in a handful of stocks, and it was returning quite well. Now that has kind of come off a little bit, and now it's back to this risk on appetite that people want to get invested into newer names that could, be that next generational return. Be Shopify from 2015 that has become, the biggest tech company in Canada. Invest in Constellation Software, again, 12 to 13 years ago when, it was a $50 stock and today it's a $4,200 stock, right? These are the opportunities I think that are coming to us again, where there's a lot of great opportunities ahead. There are a lot of great companies in Canada being built on the private side, and that's where we think there's a lot of ripe opportunity for those companies to go public. I don't think we've ever seen as many private tech companies in Canada at the size and scale that we have today than ever before in our history. So it's a great time overall for Canada, and it might not necessarily happen in the next 3, 6, 9 months, but this is a long-term better than we've ever had in the Canadian markets.
Dani, as you're giving me this update, I got to tell you, you're taking me my mind to these social media posts that you've been doing that I have to talk about. I'm picturing like the barbecue sauce dripping off your face and the holiday themed book reading. I mean, your ability to do the most cringy, awkward kind of posts, like on a sustained basis, I got to commend you. I love them. They're full of value, but you're bringing this humor and this style that I know is authentic. That's amazing. So how long have you been doing it now? A couple of months? It feels like longer, but I was looking back at some of your posts and yeah, kudos, man.
Yeah, no, it's been about 2 months now. The genesis idea for this was because we can't have a 5-hour podcast. How do we get information out about the great companies listed on our marketplace in 2 to 3 minute digestible videos? Because that's what people like to watch. I feel like a bit of my inspiration is if people don't know Nathan Fielder, I suggest you go back and watch Nathan For You. It's a great show. He's actually done a couple more. I went to camp with Nathan Fielder about 25 years ago. So I always try and be like, could I ever top him? No, I can't, because I'm never going to get HBO to give me a multi-million-dollar contract to come up with idea generation. But can I at least on a weekly basis come up with one idea to do LinkedIn and grab people's attention? So far, it's working. My only non-fan still is my wife. And so I'm telling everybody here, I doubled down this week on the video. I'm going to be tripling down next week until she accepts that I will not get fired for these videos. Louis, our CEO, if you hear this, please don't ever fire me over these videos. I'm joking. He has promised, by the way, to get involved in one of these videos. So I'm putting this on record right here on the podcast today as well. Louis, you're going to be coming on the videos. But again, this is just, we need to get people's attention, quick, digestible sound bites. There's 3,000 publicly listed securities in Canada. How people are ingesting information is constantly changing. It's not the same thing that it was even like 3-4 years ago. And this is just a good way for you to hear about, companies that like we highlighted this week is Sharp Therapeutics, a life sciences company out of Pittsburgh that listed. Or Satello Bioscience raised $57 million at the end of the year to advance their clinical trials of a treatment of Duchenne, muscular dystrophy. You would never hear about this. The average person, is not going to hear about these companies on a day-to-day basis. Yeah. This is our way. Grab your attention, and then you're going to hear about them and go look it up. We're not saying good or bad. That's not what we do. Also, as my legal counsel hearing this, we do not solicit investment advice, but all we want to do is just let you hear about what these companies are doing, and then you go make the investment decisions for yourself. And that's what we're trying to do all the time, is get people hearing about the companies. There's great companies listed on our marketplace. Some of them are under the radar, and we want people to know about that. That's the TSX Venture. There are a lot of companies that are under the radar that you will regret in 2 years that you didn't hear about them earlier, because they will become some of the biggest companies in Canada overall. And we're just trying to get those companies in front of you earlier on when you're not hearing about them typically.
Yeah, I think that's great. Inspiring. I'm going to borrow a page from your book with your shout outs to your wife. Her name's Lauren, right?
Yeah.
Well, my wife's name is Lauren too. So Lauren, I love you. And not your wife, Dani, but
you can love her too. She's really nice.
Okay, I love her too.
Yeah.
I love her too.
Lauren, you hear that? Somewhere in the virtual world. Yeah.
Yeah. To the Laurens, Dani, and I love you.
Yeah.
Yeah, that's great. I agree. I think getting the word out and doing so in a way that's a little bit more digestible. People aren't going to get them from, regulatory reports or the way the media probably tends not to cover them as much. And so, I think it's great. And I've been up to some of your breakfast, series where you've got these companies presenting. Most people aren't going to those in the general public, but I think would love to hear the kind of exciting innovations that, are earlier days. So I love it. Keep it up.
Yeah. And if you have any ideas for me, because it's like a cold open of SNL every week. I have a team of crackpot writers sitting Sunday night at the kitchen table / me being like, oh God, I have to record a video tomorrow morning. I have no ideas. So for all the people listening today, if you have any great ideas for things that won't get me fired, but would be a really funny cold open, send them along.
Okay, we'll put this into the comment section in LinkedIn and try to get some ideas going. The call to mom was classic.
Also, my mom really does enjoy them too. So shout out to your mother.
Shout out to your mom.
Yeah.
So yeah, just changing gears. One thing I'm curious about is sort of U.S. market. I think there's some unique elements of what we do here in the venture side that aren't accessible in other markets. And if I'm not mistaken, you're looking to attract U.S. companies as well to the Canadian markets. Give us a little bit about the U.S.-Canada dynamic.
Yeah. So, the 11th province, the USA, as we refer to them now, right? Because I assume we'll be taking over the U.S. in the coming months. A reverse
takeover.
We'll see. Hopefully they're actually going to work. But, the U.S. is, a massive opportunity in terms of great companies being built that are also stuck with capital financing options overall. Everybody thinks, oh, I'm going to go list on New York Stock Exchange or NASDAQ. But you really have to be at a massive size and scale to be relevant there and to be able to afford the cost of being listed in the US. There are a lot of great companies in the US that are being built that are not yet right for the New York Stock Exchange or NASDAQ. As a result, we talk to these companies about using Canada to go public at an earlier stage, and then maybe one day return to the US at the appropriate time. Canada, as we kind of alluded to earlier with our regulatory environment, has a much more effective mechanism in place to support earlier stage companies and help them grow through access to capital overall. We have people actually on the ground in the US who are speaking to entrepreneurs and investors on a daily basis. And that same typical profile of an earlier stage company, maybe around the $40, $50 million valuation, that needs maybe $5 to $10 million of growth capital to get them to that next inflection point. Why not go public in Canada first and grow overall? And a company that's done it over the last couple of years that we're very proud of, it's actually no longer listed in Canada. It's going to be called Real Brokerage. It is a prop tech company. They basically have a platform for real estate agents to come on and, make the whole home buying experience a little bit more cost affordable, reduce some of those friction points. They had about 1,000 agents on the platform when they started going public on TSX Venture about 4 or 5 years ago. It was about $20-30 million market cap. They raised a few $1,000,000. Fast forward to today, they graduate to TSX. They listed on NASDAQ. They have about 7,000 agents on the platform now. The revenue has grown significantly. It's north of a $500 million market cap. And that company only could have gotten their, listing on NASDAQ through their journey in the Canadian markets, because they're able to grow and scale in the public markets, because that gives them that financing, that gives them that profile, that visibility. Another reason you go public is just building your profile and credibility overall. People know that you've gone through the rigor of being public, so you must have at the least some standards overall in how well the company is managed and the growth potential of it. It's not to say you can't have those same standards in the private market, but everybody can go and see, oh, this company has $50 million of cash on hand. I know they're going to be around for the next a while. I want to do business with a company that I know will be around and have confidence in that. So the profile credibility is really vitally important. And that's what a lot of US companies are attracted to. And again, this is not for every company. We are always very clear about this. I do joke about 99% of companies I speak to will never, nor should they ever go public. But for that 1% of companies, this is a great option available, and they need to explore it and understand how this could benefit them over the long term.
We hear about the success stories, I think, many times. I know we hear about huge failures, but there's also this sort of in-between companies that just get a little bit stuck in the cycle. They're kind of like sub 10 million, sub 5 million, sub 1 million market cap, and just, they're hanging around. They're maybe getting sort of drip feeds of capital to keep it going and to fight another day. But what kind of advice, what kind of conversations are you having with those companies? What should they be doing? Should they, at that point, think about going off the market, or is that sort of the kiss of death because then access to capital gets even harder?
You got to manage through the tough times a little bit. We do see going private transactions. We do see those companies that maybe right now it might be a little bit challenging to be on the public markets because, there's not going to be an interest from investors in funding that. Maybe one single investor wants to just come in and fund it, but they don't want it to be public at that point because they'd rather just retain control themselves. So that company could go private and then return to the public markets later on when the company has kind of righted the ship overall. We do see also times where those types of companies who are struggling, maybe they'll change the business up. Maybe they'll pivot into something else and change the business. We've seen this from a lot of serial entrepreneurs on our market who have, gone down one path. It hasn't been great, and they'll pivot the business and kind of go into something else and still utilize that public share currency as a way to grow the business. But you're right, like there is a point sometimes where maybe the public markets aren't supporting them. They might go private and then they'll come back. And we've actually seen a host of companies through the years who go public, do well, maybe private equity comes in and says there's an opportunity here because it's not growing as much. They'll take it private. And then 4 or 5 years later, the company will come back public. It's part of the natural cycle overall. And we've had a lot of commentary the last year or two about, we see a lot of companies go private. Yeah, that's just the normal course of cycle. We had in 2020, 2021, a boom of companies going public. We will see companies continue to go public, and we will continue to see companies go private. Even in the best markets in the world, companies will go private. It is just part of the overall ecosystem. And, what we want is just companies to succeed. And that's what we're championing for. And if it gets to a point where, hey, the business is really not performing, they're burning a lot of cash.
Makes sense.
Yeah, it might make sense for them to take itself private till they're ready to be able to face the rigors again of being a public company.
Dani, you mentioned the stock as a currency for growth. And I just want to maybe take that a step further, because I don't think you brought that up as one of the reasons to go public earlier, but I think it's worth exploring and discussing. The opportunity to conduct M&A and to leverage the currency from your stock to do so in a way that would be much more challenging on the private side. Can you expand on that a little bit?
Yeah. So M&A is a huge part of being a public company. We see a lot of M&A of the go privates, but we've actually been seeing a lot of M&A of our public companies buying private companies, as an example. Let's say like our market has actually never been bigger overall in terms of the market capitalization. 2015, we were around 2.5 trillion of overall market cap. We're now at 4.5 trillion. So it's grown significantly. Now that's a lot because the companies are getting bigger on our marketplace. And a lot of that is because of M&A. And when you are looking to acquire companies in the public or private markets, you have to have different ways in which you'll be able to acquire that business, whether it be cash, debt, shares, earnouts, whatever it may be. The public markets, the fact that you are having liquid shares, that you can offer up shares in your company, which is liquid, is a huge advantage relative to the private markets. And so as you're negotiating terms, it does make it a lot easier because you can offer that up in lieu of cash. You don't necessarily have to go out if you're doing $100 million acquisition target and go raise $100 million in cash and debt. You could actually say, okay, take 30% of that transaction in shares of our company.
Which you could do so privately, but it's not like cash because they know they're locked up. Yeah.
They're locked up. Like it's 30% in a private company of shares, which I don't know when I'll ever be able to liquidate necessarily. So you're generally going to discount back those shares quite substantially because you don't know what the liquidity is. Here, you know exactly what the shares are worth today. You'll know what the provisions of when you could sell those shares. There might be some lockup provisions related to that, but you have more clarity around what those shares are actually worth. And so we see a lot of companies on our markets who very much are going public because they have an M&A strategy. And they want that liquid shares as another tool in their toolbox to go out and set to acquire these companies. The other thing around the M&A piece that I should highlight too is bought deals and subscription receipts. In the public markets, if you have a target company that you want to acquire, you can actually go to a bank and basically say, can you go out, help me finance this deal overnight through some different type of mechanism? It might be a subscription receipt, which basically is a financing contingent upon me closing the deal. So you're going to de-risk that deal in its entirety by knowing I'm going to go out and raise the money from the public markets. And so I'll have the cash in hand, and then I will consummate the deal, and this all will be publicly announced together. And if the deal doesn't get closed, you'll go return the money to the shareholders. It's a great flexibility option that, again, de-risks part of the financial piece of getting a deal done overall. And a lot of companies will use this. So Propel Holdings, if people don't know this, it's a great fintech company that trades on TSX. In Q3, Q4 of this year, they announced they were acquiring a UK company called Quid Market. And they announced as part of this a subscription receipt of it was between $70 and $100 million to acquire that company. So they were going to fund it with a bit of cash on hand and other pieces overall, but they want to get the cash on hand from the public markets and not just use their balance sheet. So they announced a subscription receipt the day they announced the deal that they were going to acquire Quid Market. They went out overnight, raised the money, and then once that deal was closed, the subscription receipts turned into shares of the public company. Had the deal not closed, that subscription receipt, the money would have returned to shareholders. So that's how Propel was able to guarantee themselves will have the financing lined up. So we're constantly seeing companies utilize their shares as currency. And yes, it is available in the private markets, but it's not as liquid. And the other thing we'll talk about with the public market shares is it's a way to retain and attract talent. As you're going to seek new employees, as you want to ensure that your employee base stays on and is happy, having a liquid share is a lot easier to get people on board with you, because people will have bills to pay. People have mortgages to pay, daycare expenses. And when you're a private company and you're holding on to shares of the company, but there's no liquidity event, you're faced with the challenge of, okay, it's great. I have $50,000 of shares of this private company, but I have no way of exiting it. The public markets, when you have $50,000 of shares of the company, subject to, again, legal restrictions. Lawyers, can you hear that? You can generally just go sell it in the market during certain trading windows. And if you need that cash, you can go sell it. So it's a lot more flexible to attract talent overall and keep them as employees.
Yeah, great points. And you got me thinking as well about IR. I just want to make sure we cover some of the critical success factors. I think about the CEO, their chief storyteller, visionary. They need to be out in the market and telling the story. And then the IR component, which is, I think, one that folks come to learn when they go public. That's a real critical competency to have. And so give a little bit about what people need to know about IR and how critical that is for success as a public company.
It's a great point, because that's what sometimes gets people hung up on being a public company is, how much time do I have to commit to it? And it can vary quite widely in terms of what the investor relation component of a company is and who's actually responsible for it. But the critical piece that we say is, think about your investor relations strategy well before you go public. Think about what conferences you're going to be attending over the next 12 to 24 months. Who's going to be responsible for that? Is it going to be the CFO or the CEO? There are a lot of companies where, the CEO actually isn't that heavily involved in the investor relation component. And that's not necessarily a bad thing. The CEO might be the product person, and the CFO is actually the one who knows how to explain the company's story to the public markets very well. So decipher who's going to be actually doing these roles and responsibilities, and what is your actual strategy for it. Which bank-led conferences am I going to be attending? Who's going to be answering the retail questions that come inbound? Who's going to be doing outreach? What external investor relations firm might we be utilizing, if we should be utilizing it? And this should be, again, very well laid out, very well articulated internally. And it also should be like an ongoing document where it's like, this is our key messaging and strategy, and we don't stray away from this messaging. The last thing you want to have is different people giving different messages about what is the go forward plan, what is our metrics kind of looking like, and then also what are the metrics that we're going to talk about. For a tech company, it's really critical to say, here are the core key performance indicators for our company. Here are the core metrics. And whatever metrics it is that you're going to go show to the street, you don't change it up ever. Because if you go out and start pulling a metric out of your presentation deck, somebody's going to pick up on it and be like, wait, you used to show this specific metric as a leading indicator of how well the business is doing. I don't see that in this quarter's deck. That's a red flag for me. You have to be very assured of the business and how you talk about all these numbers overall as leading, lagging indicators of the health of the business overall, and how your CFO and CEO is going to be talking about it. how you're going to be talking about our next 6, 12, 18, 24 months, and the promises you're going to make. Don't under promise, under deliver on the public markets. I mean, don't do that with your private investors either. They're probably not going to be too happy either. Also, don't sandbag and don't just under promise, over deliver every quarter. People will also pick up on that. But have it at a reasonable base where you give some good, guidance, expectations, and you deliver on that.
So do you see the CFO as playing the key role in that regard and sort of, almost reining in and keeping control and making sure there's that level of consistency and understanding what those numbers are today and what they'll look like in the future? Because I know CEOs can get out there and start telling stories and spinning. And then IR could take those cues as well, wanting to, make an immediate impact. So do you see CFOs as really the key person in terms of keeping it all together? And then maybe just expand on your experience as it relates to CFOs for public companies and the importance of that role.
Yeah, absolutely. I think you've described it quite well. Most of the time, the CEO is the visionary. A lot of times, it could be a founder-led company where the founder is the CEO, and they've got into the company to this point, and they know how they're going to continue to grow the company through product innovation, different market strategies, or M&A opportunities. But it'll all come back to the CFO in terms of the questions from the street of, love the vision. How are you going to do this? Because I'm paying for the future cash flows of this business. And how are you going to be able to deliver on those results in either a cost-efficient manner, or how are you going to fund that future growth? If you're burning cash right now, how much longer are you going to be burning cash for? People have to believe in the story of the company. People have to believe that they know how to actually execute on these plans, but it can't work without the fundamentals of the business itself, and people will pick that apart. It's coming down to how much capital is going to come back to the company, and how am I going to see returns as a company? Because will somebody else pay a higher valuation down the road for this company because they see that they're generating more cash flow, more net income, paying out higher dividends. And that can't happen without a confident CFO who knows how to do this and has a good plan, knows how to seek out opportunities to refinance debt at a lower rate, knows how to manage operating leverage. These are key questions that will come up constantly from the street. And there are CFOs in private companies who, may not know how to message this as well. It's something that they have to learn because they're really used to just getting the same questions from their private company board on a quarterly basis. But now they're going to get picked apart a little bit more in the public market. So I just have to be prepared for that overall.
Yeah, I always thought of it as, something has to tie back to a spreadsheet that, shows, where that number comes from. If margins are going to go from 50% to 90%, that's okay to say that. But you need to understand, how that math works. So I think a CFO is always, tracking those communications, even what a CEO is telling the market, and making sure it always ties back to, real numbers. On the CFO side, obviously, fractional CFOs is something that I think about quite a bit. I think I've seen an increase in utilization of fractional CFOs, and I think it's been there for quite some time, certainly when it comes to companies preparing to go public. And that's a whole new competency of getting the financial statements, IFRS and audit ready, filing a prospectus, or preparing and filing a prospectus, and then obviously the ongoing competencies required to be public. And I think that's many times the point at which companies will go hire their first full-time CFO. But we also talked about companies that are kind of stuck and maybe are more cash constrained. Do you see fractional CFOs as a utilized solution commonly? And do you think there's awareness of the availability of fractional CFOs for those companies that don't need to spend the full-time salary of a CFO?
For sure. So in our opinion, fractional CFOs are a critical piece of the TSX venture. A lot of these companies don't necessarily warrant needing somebody at the desk 5 days of the week in a full-time position. These companies are raising money. They're more, not saying everybody's conscious of their cash balances and their spending, but it's a little bit more critical for TSX venture companies because they're not raising at the same size and scale. They're only raising a few $1 million and they want that money to go quite far. And so bringing on a high-priced executive doesn't translate necessarily into the same value because that company has the visionary CEO. They're still at that earlier stage in terms of revenue. And, maybe even the CEO is actually doing half the sales calls themselves because they're still at that earlier stage. And so they can actually speak to the sales pipeline very, very openly and honestly because they're involved in it. And then don't bring in that CFO, but just bring in one who can actually just manage your public company requirements and give you a little bit of guidance around the strategy and how we should think about going out raising money over the next 12 to 24 months. And so we see a lot of companies who go public with us utilize this. And it's not, no investors are knocking this. It's kind of par for the course that, investors are fine with the fact that there is a outside firm handling the day-to-day operations of the financial activity of that company because it's actually reducing costs, right? It's a more cost-effective way to run the business at the end of the day. And those people who are doing it know what they're doing. You don't necessarily have to bring somebody up to speed on how to run the public company. You have in-house experts like yourself, David, and your team who can just manage all of those questions and all of those processes without spending hours learning how to do it. The systems that are already in place, what the expectations are, and you can even up or down the commitment to those companies. It's like, okay, we're doing a bit better. We need more activity. Let's just maybe bring someone on 2.5 days a week versus 1.5 days a week because we're kind of doing a bit better and we need a bit more hand holding overall. And then at some point, those companies, they outgrow the fractional CFOs and say, okay, hey, we're doing really well now. We can afford a CFO. Let's bring on a full-time one. We have seen the rise in that activity for sure over the past number of years because it's a great way to manage the costs of a public company. And we're very mindful of not having costs continually rise to operate a public company. It is something that we constantly talk about with regulators is the public markets are great. We can't have costs get out of hand to manage a public company. Fractional CFOs, external IR firms, those are key components to help people manage more of the costs of running a public company on a day-to-day basis.
Yeah, that's great. And I think it applies fractional anything really. We talked about CFO and IR. It could be a commercial officer, marketing, leadership, depending on the requirements for a business, chief legal officers or in-house counsels that are now many times leveraging fractional, depending on the business. So that's really great. Before we go, Dani, we do ask all our guests, what would you tell yourself personally or professionally, in terms of what you know now that you didn't know when you first started out in your career?
I would have said to myself, figure out this whole Instagram thing a little bit earlier because, you could have been a 2-minute video king there. But unfortunately,
you could have been Nathan.
I could have been Nathan. I side hustle, just so people are aware, as a fruit influencer on Instagram. So if you want to follow seasonal fruits, I do share seasonal fruits a lot on Instagram. But in all seriousness,
is this real? No,
it's actually real. Yeah, it's actually a real thing. I post pictures of children's birthdays and fruits. I'm very big into fruits. Everybody eat your fruits. It's natural sweetness. But what I really remind people of is everything is long-term in nature. I actually think people underappreciate that. And sometimes I think people just try and think you can just steal an easy win in the short term, but that's not sustainable, right? Like too many people cut corners or overspend because they think they can get ahead of themselves. You know, going back to this whole fractional CFO, like I wish more companies were using fractional CFOs long time ago, because it's a great way to make your dollars go further. Building cost efficient, sustainable businesses is underappreciated in this world. And I think, you know, there's a growth element and we need to continue to grow. But I think people need to get back to the basics of building businesses. And I remind people of that. You will be rewarded handsomely for building good, sustainable, long-lasting businesses. That's what the public markets is about. And just remind yourself of that. You will actually be more handsomely rewarded in the long term if you're more thoughtful short term. I tell people that more and more often these days is don't cut corners or even pay the extra dollars for something that actually will be beneficial long term. Don't cut costs in place where you shouldn't cut costs. And so think more and more about what do you want a business to look like in 3 to 5 years than what you want a business to look like in 1 to 2 years. Because if you only keep having the 1 to 2 year mindset, you're never going to get to a 3 to 5 year outlook overall. And I've watched this now for 13 to 14 years. Let's think about how we can build $100 billion companies, $50 billion companies, $100 million companies, and be more thoughtful overall to that approach. Let's be aggressive. Let's shoot for the stars. But like capital isn't endless, and I think that's what I wanted to drive back. It's capital is not endless, so let's be more thoughtful about how we're building these long-term great businesses.
Great stuff. Really think that's a helpful perspective for anybody in anything they're doing. You know, shoot for the stars, but you know, don't fall flat on your face. And
Exactly.
managing that, I think, is really important. Hey, this has been, I think, immensely valuable for our audience. I certainly learned a lot, and I think our Laurens will appreciate our shout outs and the love we gave them. But Dani, really appreciate you doing this. Hope you'll do it again sometime soon. Thanks so much.
Absolutely. And if we can change the title of the podcast to We Love Laurens, I think we get a lot more listeners.